Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined the community for the first time, a massive welcome. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. Always very excited, but we are covering some big stories in today's episode. Later in the show, we're going to be joined by Sam Gordon, the founder of Australian Property Scout. He is joining us for a quarterly update. We're going to try and make this a quarterly thing where he gives us an update on what's happening in the world of property. Prices, we want to know what's going on, but also like the news that we need to know. So we are going to be joined by Sam later. But before then, we're going to cover some of the big news stories, particularly coming out of the US, big tech, nuclear energy, data centers, AI, a lot of the big buzzwords of 2024. Before we do that, one key piece of housekeeping. We said Sam Gordon is coming onto the show later. If you love Sam and you want to see more of Sam, he's got an event coming up that we said would give a shout out to.
He does. He has the Australian Property Scout Summit here in Sydney on the 17th of November from 9 till 5. Full day affair at the Star City Event Centre. Go and check it out. I think when we interviewed him, he said that he's going to be running through full scenarios on how to actually build a property portfolio from scratch on the whiteboard, plus a bunch more other stuff, going into detail on his own story. A lot to learn from him. So if you're interested, we'll throw a link in the show notes, but go and check it out.
News and markets.
All right, Bryce. Well, for the news today, we really wanted to get our head around this nuclear power and AI story, because I think the headlines have sort of been drip fed to us over the past, call it 2 months?
Yes.
But we sort of wanted to dig into it and really understand what is going on. So let's start with the headlines and then get a little bit deeper and understand the bigger story. We're actually going to close out with some potential ways to play it as investors as well.
Yeah.
But really, let's start with the headlines. So 10th of September 2024, Oracle announces plans to build a gigawatt-scale data center powered by 3 small nuclear reactors. A couple of weeks later, 21st of September, Microsoft signed a procurement deal with Constellation Energy, and as part of that deal, they're restarting the 3 Mile Island nuclear plant. 3 Mile Island, for people who are unfamiliar, shuttered in 2019 for economic reasons, but in the 70s was the site of America's biggest nuclear accident, quite infamous for that. Then, fast forward a couple more weeks, 16th of October, we get 2 dueling announcements. One from Google, that they've partnered with Kairos Power on a 500 megawatt advanced nuclear project really focused on small modular reactors. And on the same day, Amazon inked 3 nuclear power deals, one with Energy Northwest, a second with X Energy. They were both around small modular reactors. And then an agreement with Dominion Energy, one of the bigger nuclear power players in the States. And they also led the funding round, a $500 million funding round for X Energy. So, to take a step back there and to take a breath, in the space of a month, we have all 4 of the biggest players, all 4 of the hyperscalers, the cloud computing and data center giants, Oracle, Microsoft, Amazon, and Google, all directly inking deals with nuclear energy companies.
It's the nuclear power renaissance.
Definitely.
Yeah, like this is putting nuclear on the map again.
Yes.
And it's going to, we'll look back in, I don't know, maybe in 5 years, but 10 years and be like, AI was the moment that nuclear power became like forced nuclear power. And ironically, so far into...
Ironically, as like a baseload form of low carbon electricity, like if AI is the technology that underwrites these investments, and then let's say hypothetically, the AI bubble bursts at some point, some of the hype comes out of the market, data center demand softens, but that nuclear investment has already been made. Potentially, rather than turning off the nuclear power,
these guys are just energy companies.
Well, no. But like these nuclear power plants that have been underwritten and these investments, they can start to actually offset the baseload generation that coal and gas have been doing.
Yeah.
So anyway, that's a bigger conversation.
That's a whole other thing. But yes, it's pretty phenomenal.
But to put in context, so I got this from the International Energy Agency. To your point around it's a nuclear renaissance, between 2010 and 2021, despite total energy demand growing at about 2.5% annually globally, nuclear energy generation flatlined, didn't grow at all. And that meant that globally in 2010, it was 13% of global energy production. By 2021, it was down to 10% of global energy production. And I think what we're going to see is the next 10 or 11 year period, 2021 through to 2032, where certainly it's going to be a different story.
Yeah. We want to look at what's going on here because there's a series of interesting facts.
Well, I guess the question is why are the hyperscalers for the first time ever directly procuring energy?
Because when AI, as we know it, is an energy-hungry beast. So let's start as we know it with ChatGPT, everyone plugging in searches. In the early days, searches required 10 times, this is ChatGPT searches, required 10 times the electricity of a typical Google search. Now, of course, as AI and ChatGPT improve and generative AI becomes, I guess, even more accessible to make things like movies and music, you can assume that the power required to deliver those sorts of things is going to be vastly more as well.
Yeah, and we know that what is powering AI are these data centers. That's where they get their compute power from. And data centers themselves are just massive. So an average data center today uses the electricity of about 750,000 homes. And that is current generation. So some numbers we found, current generation of data centers require about 30 megawatts of electricity demand. But Dominion Energy, which is one of the nuclear power players, in their latest earnings call, they said that requests for new data centers massively bigger than current generation data centers, ranging from 300 megawatts, so 10 times, to several gigawatts.
Wow.
So what we have now isn't even on the scale of what is being built. And what is being built is a hell of a lot. Just to take Microsoft as one example, so they've just signed off on $100 billion investment plan to purely build new data centers, and that's just Microsoft. In Australia alone, they've just committed $5 billion to build new data centers. That's Microsoft's largest single investment in Australia in its history, and it's been in Australia for 40 years.
Well, back in 2019, Microsoft planned to open 100 data centers over the next decade. And here they are now building more than 100 a year.
Yeah. Yeah, that is wild.
So it's unbelievable.
So then if we zoom out and we say, okay, what about, and these are US numbers, but at a national level, how big is data center demand going to be as a total percentage of US electricity demand? This is from the US Department of Energy. They expect by 2030, data centers will consume 9% of total US electricity generation. For context, the US Energy Information Agency thinks crypto mining uses about 0.6% to 2.3% of all electricity per year. So, yeah, AI is going to be orders of magnitude.
Yeah.
Now, by 2026, so what's 2 years? Well, I mean, less than.
Yeah.
The International Energy Agency estimates that globally, electricity consumed by data centers will be the equivalent of Germany.
So where are we going to get all this energy from?
Well, that is the question. But more importantly, given the climate context, is where are we going to get this without killing the planet?
Oh, well, the tech companies would be crucified if they started going out and buying coal stations.
Well, yeah. Yeah, well, I mean, they just buy offsets. But yeah, you're right.
They could not do that.
But this is, and, you know, like, so the tech companies have basically said, because they were like, they had big climate commitments and they've come out and said, we're probably not going to meet them anymore. And it's because of this compute demand, data center demand, AI. But that is where nuclear comes into the conversation. And like that electricity demand that we've just touched on is why all four of the major hyperscalers have signed deals, direct nuclear deals in the past month.
So you're right, Ren. I did say earlier that this is going to be the nuclear renaissance, and this could be the start of it. Well, it feels like it's definitely going to be the start of it. So the International Energy Agency, even with their most conservative scenario of how nuclear plays out for here, has it growing at a compound rate of about 2% through until 2030.
And that's compared to the no growth
Flatline.
we saw over the past little more than a decade.
They say that more than 90% of the new worldwide nuclear power capacity will actually come from Asia through until 2030. 7% annual growth through that destination, I guess, or from that through that period. Continent, thank you. Destination.
To put that to put that in context, China in August approved 11 new nuclear reactors across 5 sites, which was a record amount of permits that they'd ever approved. It was something like 200.
For tech?
Well, I think
is this in parallel to what's going on with?
In parallel, yeah. It was about 220 billion yuan investment, which was massive even for China. So, yeah, I think Asia is going to drive a lot of it. South Korea is obviously seen as like has the technical expertise when it comes to nuclear, like building reactors. It's not just Asia. Like Europe, we're seeing a nuclear renaissance or renaissance? Both.
Yeah.
As well, in Europe, it's going pretty well as well.
Yeah, the UK government recently announced an acceleration in its nuclear strategy to generate up to 25% of the nation's electricity by 2050, creating the Great British Nuclear, a body designed to support nuclear energy and invest in small modular reactors. So, yeah, it's all happening over there, but certainly not happening here in Australia.
Yeah, we're avoiding that part of the conversation. If we go over to North America, we're seeing obviously big investments because of the tech players in the US, but also Canada. So Canada had a 30-year hiatus on nuclear energy investment, and it's now reviving its nuclear energy industry. The point is, you touched on Australia. It's kind of like what's happening in Australia is somewhat immaterial to the global story. My view is kind of, if things play out as they seem to be playing out globally, eventually Australia will be dragged along. Like the technological innovations, if small modular reactors can be commercialized and shown to be commercially viable, like we will play catch up to the world at some point.
Go Aussies. So to wrap it up, the question is, how do we actually play this trend? Like, it's massive. It's huge amounts of investments being put in by these tech companies. So there are a couple of ways that we can do it. First, the obvious way is investing in the nuclear energy companies themselves. So you've got China, General Nuclear. You've got France's Électrique de France.
Yeah, EDF.
Yes, EDF. And then, as we've spoken about, over in the States, Dominion Energy and Pacific Gas and Electric, or Constellation Energy, 3 big players over there.
Yeah, there's a heap, but they're just a select sample. Uranium stocks, you could play the big Kazakhstani miner. You could invest in the commodity itself. There's heaps of ETFs that also allow you to invest. But I think there are perhaps more interesting ways to play it. And you came across a few companies that have absolutely been killing it back on the back of nuclear.
Not 100% related to this, but they all play a part. Apparently, it's the picks and shovels, those that are industrial energy involved in the inputs that go into building these small modular reactors. So 3 that I'd seen. So there's Mitsubishi Heavy Industries, Siemens, and GE. So Mitsubishi's up 177% year to date. Sorry, last 12 months. Siemens is 50% and GE 127%.
Yeah.
But for Mitsubishi and GE, the growth of those you can see where these announcements have started to come into play because the last few months particularly have been strong. So GE's back.
Well, maybe let's not call that too early, but it's
solid 12 months.
It needed something. It needed a change.
Yeah, but it just goes to show, like, all these announcements and the amount that's being invested in the space. Like, you don't have to just go for the obvious answer.
Yeah. A few other picks and shovels plays. We interviewed Katrina Burns from Wilson Asset Management maybe 6 months ago, and she flagged Quanta Services as a company that they're investing in to play this nuclear renaissance.
Yeah.
They're the biggest player in maintenance and upgrade work for US electrical transmission lines. So as all this new generation needs to be added to the grid, they are going to be ones that potentially benefit. I mean, in Australia, Goodman Group has just been a story of someone needs to build the data centers,
Yeah.
like, the sheds.
Yeah.
And they've killed
Nailed
it.
it.
So I think there's some ways to play it, some different ways to think about it. Where I end, and this is perhaps on brand for us, perhaps a little bit boring, is you can just buy the index. It's kind of like if
What index?
the global stock market index. I don't know, or like
the nuclear index?
No, I wouldn't. I'm not. You could buy a
Energy?
thematic ETF, but I'm saying like, for example, Goodman Group is a classic example. It's driven. It's been responsible for a large part of the gains of the ASX 200 over the past 12 months. It itself has close to doubled. I think it was 70% plus over the past 12 months. No one knew that Goodman Group, well, not many people were calling Goodman Group as like the star of the ASX 200, but it was in the right place at the right time and it benefited. And however this story plays out, if you own the index, you will benefit from whoever's in the right place at the right time, however the world moves.
Yeah.
Yeah. Which is boring, but, prove
it's
me
fair
wrong.
though. It's fair. Yeah, no, it's fascinating to see what happens. I like it. I like the fact that it's forcing. I hope it forces what we think will happen, which is this becomes power that is used beyond just big tech companies sucking it up for AI, and it meaningfully becomes a contributor to our energy mix in society. So
if you think about past stock market booms, so like the classic example is like 2000, the 90s tech bubble that burst in like 2000, 2001. There were a bunch of investments in technology made there that were then kind of like white elephants. Like there was a lot of fiber optic cable run into the ground, especially in the US, that was then seen as like a wasted investment. And it was, because a lot of those companies went out of business. But that laid the groundwork for the next tech boom. Who knows? Maybe like AI is a bubble. Maybe at some point the bubble bursts and we realize that it was a bit overhyped. But like hopefully some of these investments will have benefits beyond it.
Yeah.
Or maybe AI is not a bubble and it's about to change the world. But,
or
like
both.
or both. But yeah, it's more carbon-free electricity is never a bad thing.
No.
Especially if big tech companies are paying for it.
Yes. Well, we'll leave it there. We're going to take a very quick break. Right after this, we're bringing in our property expert, Sam Gordon, to get his take on what's been happening in the property market over the last quarter. We will be right back. Welcome back to Equity Mates. We are joined by Sam Gordon, founder of Australian Property Scout. Sam, welcome.
Boys, thanks for having me back.
So in this segment, we're going to be doing a quarterly update on what is happening in the Australian housing market. You have teed this up by letting us know that there's going to be a stat in here that is going to blow our minds.
It blew my mind, man.
Wow.
It blew my mind.
We're hard to impress, Sam. So,
We'll see how we go. Maybe I've overpromised you.
so what we want to do in these segments is get an update on how the market is moving, both from a price perspective. That's where we're going to start.
Yeah.
But then we also want to hear about some of like the big news stories that have been capturing your attention in the property market that we need to be across and updated on.
For sure.
But let's start with these mind-blowing numbers and how prices have moved for the last quarter.
Do you boys mind if I take the reins on this for half a second?
Yeah, great. Yeah.
I checked the potty charts this morning, and you boys are sitting at number 3 in Australian business podcast charts.
Hey, there
I was
we
going to say
go.
when I walked in again, I'm going to save it for the potty.
Nice.
Boys, how good. Congratulations.
Thank you.
Thank you. Yeah.
Always
We've
been.
met you at the top.
Mate, you've surpassed me, buddy, by a long shot. But boys, congratulations. Look, the stat that really blew my mind this morning, and I think will blow most people's minds when I was going through these things and pulling some things out. Obviously, we've just finished the September quarter, right? So from the July to September, growth numbers over the quarter and over the year. Now, what is actually crazy is the Australian housing market has just ticked over $11 trillion. It's been a $900 billion increase in the past 12 months.
Wow.
$900 billion increase.
Yeah.
Almost $1 trillion in the last 12 months.
Yeah.
And when I read that, I had to double check it, and then I had to verify. I was like, are you serious? Like, that is
All
crazy.
from
man.
Perth.
Well, I think this is the funny thing. When we start to look through the stats, there's 3 capital cities that in particular are outperforming, but then a lot of the regionals are going through significant uplifts. And I think this is where a lot of it is actually, through these 3 and then these 3 capital cities and then the other regions having really strong performance. It's showing these really big numbers across the board.
So just back of the envelope maths, 900 billion, it seems like a big headline number, but that's about 9% rise across the country?
Yep.
Yeah. So I mean, when you put it like that, it's like, okay, that seems more in the realm of possibility.
Yeah, for
But
sure.
it's crazy how big the asset class is.
Man, I think this is what's wild. And when you look at a city or cities like Sydney, which at the moment is still trending up, but very slowly, and then Melbourne, who's slowly trending back, the two biggest cities we have in the country, you look at it, just shows the power of these lower capitals and the performance that they've been able to produce, and these strong regional centres of 100,000 plus sort of people as well. So it's been cool to kind of keep an eye on and unpack, man.
So here's the number to put it in perspective: $11 trillion, the total value of Australian residential property market.
Yes.
Is that what you're saying?
Yes.
Yeah. The total value of the Australian share market is $1.5 trillion.
Okay, there you go.
So the property market is almost 10x bigger.
10x.
No wonder it's so front of mind.
Yeah, no wonder people love it.
You know what's another crazy stat though that a lot of people don't realise, because we all take, especially the younger generation, we're also almost like fixated in a way on debt and how much debt there is involved with buying property and leveraging. Obviously, it's a big part of why we get into property. But the stat around this as well, in terms of how much debt there is against that $11.2 trillion housing market, it's only 20.5%. LVR against that. So it's actually quite a low LVR against an asset that is so large in this country. Yeah. So, and it shows like majority of that would be, probably 50 plus year old sort of homeowners that have owned their properties for a very long period of time. But it just shows the strength in the housing market when you've got 80% of the market, or 80% of property has no debt on it, or 80% of it is debt free. So it's a crazy number, and it's a crazy stat really when you put it into perspective.
Gosh.
Yeah.
Well, give us a bit of a summary or snapshot of some of the growth or some of the trends that we've seen over the last quarter.
Yeah, for sure. So look, Australia as a whole over the last quarter is up 1%. So the annual rate of growth across the whole country is slowing a little bit from that perspective, which isn't, though, abnormal for winter. So winter is typically a little bit slower, stock's a little bit tighter as well. Normally by the end of the December quarter, we see a little bit more from that side because spring selling season, a lot happens in that window. Over the year, Australia up 6.7% during that time frame. Sydney, 0.5% up over the quarter, but 4.5% up over the year, so decent. But as you can see as well, if it's only up 0.5% over the quarter, 4.5% over the year, it is slowing a little bit. But as long as a city the size of Sydney and the house price of Sydney stagnates or keeps up a little bit, it's a pretty strong. It still remains pretty strong, pretty resilient across the board. Melbourne, which is probably the one that's a little bit of a worry because it's almost the same size as Sydney from a population perspective. It's very, very close to it from that side. It's down 1% over the quarter, down 1.4% over the year. There's a couple of interesting stats about Melbourne I'll finish with as well, though. Brisbane up 2.7% over the quarter, 14.5% over the year. Wow. Again, rate of growth slowing a little bit, but also could be the winter quarter. So it's going to be interesting to see what kind of comes to the back of that coming to the back end of the year. But Brizzy's still pumping, 14.5% over the year, still big. Perth, 4.7% over the quarter, 24.1% over the year. That's citywide, right? Like we've seen some of our stuff 30, 40% up over the year. So it's just been absolutely crazy to watch the transition in Perth this year. Adelaide up 4% over the quarter, so really strong as well. Really, really tight listings in Adelaide at the moment as well. And 14.8% up over the year. Still, pretty much 15% with Brizzy and Adelaide, and then Perth at 24% up in that time frame as well. I'll throw one more city in here, being Hobart, down 0.8% over the quarter and down 1.1% over the year. Now, the reason why I brought Hobart into the equation as well, even though it's a smaller population, is very, very interestingly, both Melbourne and Hobart are significantly down from their peaks in, I think it was the March quarter of 2022. So about 2.5 years ago. Hobart down 5.1% since that peak. So it's been on that kind of little trajectory slide down, but Melbourne down 12.5% in the last 2.5 years.
Across the board housing and units? Or
Yeah. So the median price across the board. Wow. So an interesting sort of dip over that time frame as well.
Well, there's a few topics we want to touch on here. We want to hit negative gearing. We want to hit some conversation around mortgages. But one of the topics was Melbourne. So let's stick on that conversation just because we're talking about it. So down double digits from its high. We've heard investors are getting out. There was a story recently about how a lot of investors are selling to owner-occupiers, and so the rental stock is actually contracting, which is unusual. Bryce actually raised before he came in today that he reckons it could be a good time to buy in Melbourne, and I said, save it for Sam. So give us your view on...
The question was more like in stocks, if this happens, down, what was it, 12% from an all-time high, you kind of start thinking, oh, maybe it's an entry point.
Yeah.
Does the same apply?
So look, Well, actually, one other stat I brought in around Melbourne as well is like it's Australia's second largest city. It is now the sixth most affordable city. So it's the third cheapest capital.
Yeah,
so
okay.
Perth, Adelaide, Brisbane have now all overtaken it.
And is that based on median income to median house price? Is that
No, so just the median house price. So in terms of like affordability or median house price, it sits now number 6 on the charts.
Yeah, wow.
It's the second biggest city by far. Like it's over 5 million people.
No
Brisbane's
brainer.
next behind it at like 2.2.
No brainer.
It depends. Though. It depends. And you know what though? Like I'm not against it in terms of the argument, but I think the thing to take into the equation is like they're still developing a lot. There's still a lot of stock sort of coming through there, and your biggest issue is the supply to demand imbalance is still falling, right? In the sense of like the market is still coming back a little bit. So the time is coming. It's just whether the time is now. And when you look at other cities that are producing 25% in a year, I'm always looking at the opportunity cost. So like if I was to buy in there now, where like and let's say it stagnates for another 6, 12 months, maybe longer, where else could I maybe make 10, 20% in the next 12-month time frame as well? Yeah. It's definitely coming. It's picking the bottom. And the bottom is a really hard thing to pick, but I think it depends on where you are as an investor. So if you're an entry-level investor trying to start, you need the equity gain, right? So you might be able to get a good discount, but if the market doesn't grow for 12 months, you could pay market value or a smaller discount in a different location. But if you did 10 to 20%, there's another deposit to then go roll into another deal. Yeah. So that's what we're always kind of weighing in and really having a good look at. Its time's definitely coming. Like it's right up there in terms of the charts of the most affordable markets in Australia right now. When we do look at what you said before, Ren, around income to house price ratios, it is right up there. But the stock is against it. The land tax reforms are against it. The rental reforms are against it. There's just a lot of things that are kind of, it's still got to bottom out first before I think it properly turns that corner. Days on market's one of the biggest things to watch, and it's a lagging indicator, but days on market are still pretty stretched at the moment. Like they're still pretty high. So if you look at most of Perth, most good suburbs in Perth are sitting sub 10 days. Most of Perth sits at sub 15 days. Most of Vic and most of Melbourne is sitting at like 50 to 70 plus days on market. So it's taking a long time to shift, and when it's that long, it hasn't bottomed. When that starts to tighten, that's when it's bottoming. That's when it's properly bottoming.
That's a good indicator. Yeah. Okay. Write that down.
Love it. Okay. You touched on negative gearing. What's happened over the last quarter on that front?
Yeah, so negative gearing is a funny one that Labor seems to love to play around with it. They lost the 2016 and 19 election, and potentially a huge part of it came down to trying to change negative gearing, that as a tax break in Australia. I think the important thing around negative gearing is, if they do it, they've got to understand that they're going to fundamentally change the housing market in Australia. It's been around for decades, for a very, very long time. Almost everyone, like for us, it's how long we've been alive for, it's been around longer than us, right? So it is going to change Australian housing at a fundamental level. And how it's going to change it is completely change the rental market. I honestly believe that is where the wealth gap will be created. Everyone talks about this wealth gap in Australia. I don't think it's here yet, but when they do this, it will create a wealth gap, because what it's going to do is really inflate rents, because people who can't afford to hold without negative gearing, they'll cash out because they're just going to be like, look, I finally made a capital gain on my property. I can't afford to hold it because my rents haven't increased as much. Interest rates are this high. If I can't write it off, I can't hold it any longer. So I'll cash out. And the idea is that, okay, well, now the first home buyers and the people who otherwise weren't able to afford to buy, they're now going to be able to buy in. The issue is the generation that doesn't have a deposit yet. Because when rents skyrocket, how are they ever going to be able to save their first deposit? And rents will skyrocket, because when all those guys who can't afford to hold it sell, they're going to deplete the housing market in terms of a rental. And at the moment, rental sits in Australia, rental properties compared to homeowners in Australia sits at around about 30%, right? If they wipe out, like realistically, if they wipe out another third or 2/3 of that market because they do away with negative gearing, if they drop it to 10% of the housing market, the rents are going to go crazy. And I think where they're going to miss the mark on this thing is it's now so embedded in Australia, and so much of Australian rental market has been built around it, is that if they pull it out, people who've been investing for a long time, like it sounds bad, but like we'll be laughing all the way to the bank, because the rents are just going to skyrocket, which means our mortgage repayments are going to be nothing compared to it as we debt reduce over time. That's where the wealth gap's going to come in. But then the younger generation coming in trying to buy their first property, they're not going to be able to save that first deposit unless they stay at home for like another, let's call it 3-5 years to save that first deposit. I think it's way too deeply embedded to bring that change around. And if they couldn't just come in and just do a blanket change of like, this is how it's going to be, because it would literally like be such a massive disruption, and not in a good way for anyone really.
Yeah. And look, without going too far down this rabbit hole, I think it's worth just adding to the conversation. They did get rid of negative gearing for a year in the 1980s, and they quickly put it back on.
Yeah.
And it was for a lot of those reasons. If you look at the inflection point on median house prices to median income, it wasn't negative gearing that saw that inflection point up. It was the capital gains tax changes. And politically, that you can't touch that now because it's so locked in politically, but like that has driven a lot of the just crazy growth of the last 20 years.
Yeah. Well, really, it's been since the 80s, right? So it's been a long time. With
CGT? The inflection point was the Howard government in the 2000s.
Okay.
Yeah. But anyway, let's not get too political.
Yeah, there's a lot to get in. I think
Yeah.
when the debate actually gets proper around it, maybe that's when we dive into it properly.
It won't happen. They
What if they
floated it. They
grandfathered it?
floated the trial balloon of we're getting Treasury to cost it.
Yeah.
And like governments should be getting Treasury to cost things all the time.
Yeah, for sure.
And even that got whacked so hard.
Yeah.
There's no way they'd do it.
Man, this is the thing, but in 2019, it was supposedly the election that Labor couldn't lose.
I know,
and then that was like
I
the last
know.
policy change. They said, no,
Yeah.
this is what we're going to do. And then bang, there was that huge swing in like a couple of months.
I would argue that they've got the political instincts to not do it again. But Albo just bought a $4.3 million beach house. So
Deal or no deal. Deal or no deal.
We'll bring it up.
Is that on your news right now?
We should bring it up. A couple of other things from the quarter. Unit values versus housing values. What's happened there?
Yeah, man. So over the last quarter, 6 out of the 8 capital cities units actually rose faster than house prices.
Yeah.
And to me, it's a very easy distinction as to why. It's even when you look at Brisbane, Adelaide, Perth, right? The 3 most affordable capital cities with really good incomes in those areas. Why are they booming? There's a lot of reasons why they're booming. One of the most important ones is they're super affordable for what they are in those locations, with those incomes. So if you look at units on top of it, again, it's then going one layer lower in terms of affordability point. And it's one of these things, man, where like I was never for units ever, right? Like I've bought a couple of units in my time. I've bought a couple of unit blocks. Owning a block is different because you don't have the strata and you don't have the headache that comes with it.
You own a full block.
That's it, right?
It must be nice.
Don't have the strata headache.
But you also control the whole thing, right? So strata, when strata's involved with something like a unit, especially in things like your high rise and stuff, they're just like, it's not an asset you want to hold. But we've had so much price growth from a housing perspective. There's this huge gap formed between houses and units, and now it's playing a bit of catch up. So it's also not a huge amount, but they are growing, and they're growing at the moment. They're growing slightly faster than houses as well. So it's been an interesting thing to watch. To use Ren's terminology before of like that inflection point, like the biggest inflection point and catch up has already happened. Like that was a couple of years ago where it did have that kind of surge, especially when the interest rates started going up. People were like, whoa, like rents are really high. Now mortgages are high. Bang. Like it was that cheaper product in a lot of areers. Units also didn't really grow during COVID because there was something that people didn't want to live in proximity. Yeah. But then when COVID came out and people were okay to live near each other again, all of a sudden, houses were twice as expensive as units. It was always going to play a bit of catch up. So we're still watching that play out. And that's actually a really interesting thing that it's still playing out and still outperforming a lot of the housing markets there at the moment. So
makes total sense, to be honest.
Yeah.
As everyone just gets pushed further and further down.
Yeah, for sure. It's the same as a ripple effect in anywhere, right? Like somewhere super desirable is a ripple effect to the next product out, whether that's a suburb or whether that's the actual product that someone lives in.
Exactly.
It's a very natural kind of occurrence.
Yeah.
So this wasn't on your news rundown, but we've mentioned Perth a couple of times, up 24% in the past 12 months.
Yep.
People would think of Perth and think it's so tied to mining, and the iron ore price has been smashed, the lithium price has been smashed, the nickel price has been smashed. It doesn't feel like it would be a time when Perth is booming, but what's been the drivers of the boom?
So, man, the biggest thing is supply and demand in the housing market. And the interesting point around that is obviously the last few years, the mining sector has been really strong, right? So a lot of the workers, the construction workers that were in Perth left and go to the mines because there's a huge amount of like big pays up there. So they left and went out, which left a massive deficit of trades in Perth City to actually be able to complete projects. So, and we saw during COVID, like, man, brickies like tripling their prices overnight because they knew that they could do it and people had to pay it. So Perth is also a much slower build time. Almost all homes in Perth are built double brick. So not brick veneer, which is standard for the rest of the country. Almost all homes are built double brick. It's a very different way of construction. It's a much longer process. It just takes a lot longer for things to come online in Perth in terms of housing. Something might get approved, but then it takes a lot longer for it to actually come to market. So many people say that mining, like Perth's so closely linked to mining, it's an over 2 million people population city, right? And I remember when we caught up last time, you were saying, well, 7,000 people lost their jobs. Okay, 7,000 people is a lot of people, right? But we're also talking about a city that's like 2.2 million people. 7,000 is not that big in the scheme of things when the employment rate over there is so low. It's also got the highest net interstate migration in the country and has been for like the last 18 months. So, man, there's just so much still pushing it from that perspective. And they're just not bringing enough to market at the moment. And there's just a huge demand there, both from an owner-occupier, first home buyer, and investor demand at the moment too. So, man, it's just going through a cycle. It's still also really affordable for what it actually is because incomes are really strong over there. House prices, they're just playing catch up. And if anything, I still think they've definitely got a way to go. How much further is, I think it's really going to drill down to specific councils and suburbs. Some have grown a lot further than others. There's some that we bought in 3-4 years ago that have done like 120, 150%. Like it's crazy. And then there's others that are only at like 80, 90%. So in reality, those 80 to 90% still have a fair bit of juice left in the tank, but the 150s, we're looking at exit because it's been so much and like how much more has it got in the tank?
Yeah.
You'd be pretty stoked if you're saying only 80 or 90%.
Nice. Well, Sam, to close out the property outlook from the last quarter, that's not the property from the last quarter, are we seeing a mortgage war between the big banks start to play out?
It's definitely coming into the equation now of the fixed rate mortgages coming into effect. It's a really good sign. Always when you see the banking economists, the banks start cutting to their fixed rates by a decent amount, 2 and 3 years specifically. When they start cutting the 1 year in a big way, that's where they know they're coming down really soon. But it's normally like the banking economist is like some of the most well paid, that there is in the country from an economist perspective. And they're paid so well because they're paid to predict when they're going to make more money out of a fixed rate than a variable. So when they start bringing them down, it's a pretty good indicator that even the banks are putting pretty big money on the fact that they're going to make more out of a fixed rate. Could be like 1.5% cheaper than a variable rate right now. They think that they're going to be coming back in a pretty big way. So it's good to see. Anyone that was like stuck at a higher interest rate mortgage, and if they can fix for 2 years and shave 1.5% off their loan, if it gets them through the next 2 years, it'd be a good time to do it. But then if you didn't have to do it, it'd probably be a pretty safe bet to wait, and something pretty significant is going to come through next year as well.
I was going to ask that. So if you're comfortably servicing your mortgage at the moment, and you see, I think Macquarie had a fixed at 5.39, and then they bumped it up a little bit. But, if you see that it's like 100 basis points lower than what you're paying, are you saying wait, or are you saying fixed for 2?
I think it depends, man. If you can service it okay, I would probably be waiting. Because like the closer that we get to this point of the cuts actually coming in, where a lot of the big guys are calling like Feb, March next year, which is 6 months away until they start cutting, then as soon as the closer we get to that, the more they're going to cut them and the lower that they're going to get. So if you didn't need to do it right now, if you were comfortably servicing, I'd still be hanging on, doing your thing and wait for them to keep coming back. It's a good sign that we're going to start seeing them come back, and it's always exciting for us as investors. From the cash flow side, you work out your cash flow sheets, you wipe a 1% off your interest rate. It's a pretty significant change.
Yeah.
So man, I'm very much looking forward to seeing that come through.
Love it. Well, thank you so much, Sam. If you've just joined the show and you're wondering who Sam is, as I said, founder of Australian Property Scout. They're a leading investment buyers agency. He also runs the Scouting Australia Property Podcast. So we'll provide a link in the show notes for that. A couple of other things. Sam will be joining us in another 3 months to do another update, but you'll also hear quite shortly the live show that we do with Sam will be released on the feed. So we're excited for that. And before we go, one more thing, Sam, you actually have a property summit coming up.
Yeah, man. Yeah. So we've got the Australian Property Scout Summit on the 17th of November. It's in Sydney. It's going to be at the Star. We did one earlier in the year in April up on the Gold Coast. And it was massive, man. It was really good. So it's pretty much just like a full day of learnings. It's on Ren's birthday. We planned it specifically for that. I want to give him the best birthday present we could. But yeah, pretty much it's going to be a massive jam-packed day full of property learnings. We think quite counter-cyclically, like you look at the examples of Perth and buying in there 3-4 years ago, and we've done it with other cities where we got in before their boom room started. We think very counter-cyclically, and effectively, we're just going to break down a lot of different things within it. If you're already a property investor, one of the biggest sessions I know heaps of people are keen on, my personal accountant's going to be there, who I'd never get on anything.
Right,
and we're doing a
okay.
tax loopholes.
I thought you were going to do a net wealth reveal.
No, God no. And tax loopholes and tactics that every property investor should know. So that one will go off.
I love that.
There's going to be like how to build 150,000 net passive. I'm literally going to break that down on the whiteboard, exactly how I would do it in today's market. Because everyone goes, oh, you can't do what you did back in the day and all the rest of it. And there's always different strategies and ways around building these things out. So I'm going to break down live on the whiteboard in front of everyone exactly how I would do it, and then have a Q&A after that. So they're just two of the things that there's going to be, but it's going to be a big day, man. And yeah, I'm absolutely pumped for it. It should be mad.
Love it. Well, you've got me excited. We'll include a link in the show notes
Thank you,
if you're interested in heading along and joining Sam. But thank you so much. We'll looking forward to the next one.
Appreciate it, boys. Thank you.
Thanks, Sam.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.